School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview. Unit 3 Financial Statements Part 1.
After completing this chapter, you will be able to explain the meaning and objectives of financial statements of a business entity, understand the basic concepts of a profit and loss account, classify income and expense items, understand the structure and components of a balance sheet, classify the various assets, liabilities, and capital accounts in a balance sheet, understand the basic principles of assets valuation, appreciate the concept of a balance sheet equation, and appreciate the linkage between profit and loss account and balance sheet. Introduction to Financial Statements. The process of accounting aims at providing the financial information about the business entity to the users with the help of financial statements. Financial statements are the formal end reports that summarize the business operations and transactions conducted in a financial year. These statements are prepared as per the accounting principles to generate systematic and consistent results. They are useful indicators of the financial health of a business entity at a particular point of time. The various users of financial statements include owners and external parties such as investors, tax authorities, government, employees, etc. It is vital to present the financial statements in a proper form with suitable contents so that the shareholders and other users of financial statements can easily understand and use them in their economic decisions in a meaningful way. There are three main financial statements of a business entity: the balance sheet, which is also a position statement at the end of accounting period; the statement of profit and loss, which is also called income statement; and the cash flow statement. Objectives of financial statements. The financial statements are prepared with the purpose to determine the financial standing of a business entity by measuring three main variables: profitability, liquidity, and solvency. Profitability. It is the ability of a business to make profit. After paying all the business expenses out of the sales revenue for a particular accounting period, is the entity still able to make a profit? Liquidity. It is the ability of a business to pay current obligations without disrupting normal operations. It is the ability to pay regular bills without having to sell off assets needed to operate the business. In short, being liquid means having enough cash to pay the bills. Solvency. It is the ability of a business to pay all its debts if the business were liquidated or sold out. A solvent business must have more assets than it has debt. These variables are shown in the revenue generated by business, that is profit and loss statement, the movement of cash in various business activities, and balance cash available, which means cash flow statement, and the net worth of the business, which is balance sheet. Income determination, basic concepts. To be able to understand the income statement of a business, the basic concepts of revenue recognition and income measurement must be clearly understood. But before that, one must be able to distinguish between capital and revenue items. The revenue items form part of the income statement, whereas the capital items are shown in the balance sheet. Now we are going to discuss these basic concepts. Expenditure. Expenditure represents any payment or outlay made for the purposes of business. The expenditures are incurred with a view to provide benefits to the business. Such benefit may extend up to one accounting year or more than 1 year. If the benefit of expenditure extends up to one accounting period, it is termed as revenue expenditure. Revenue expenditure is the outflow of funds to meet the running expenses of a business, and it will benefit the business during the current period only. It is incurred to carry on the normal course of business or for the repairs and maintenance of the capital assets. In other words, revenue expenditure is incurred to maintain the earning capacity of business. For example, salaries, rent, routine repairs of machinery, interest paid on loan, etc. are all revenue expenditures as they will only benefit the current accounting period. Also, revenue expenditures are of a recurring nature. Revenue expenditures form part of the income statement and are also referred to as expenses recognized during an accounting period. If, however, the benefit of certain expenditure extends for more than one accounting period, it is termed as capital expenditure. For example, payment to acquire machinery for use in the business. Machinery acquired in the current accounting period will give benefits for many accounting periods to come. Hence, it will be treated as a capital expenditure that affects the balance sheet by an increase in the fixed assets. In simple words, capital expenditure is incurred to increase the earning capacity of a business and is of a non-recurring nature. Common examples of capital expenditure can be payment to acquire fixed assets and or to make additions or extensions in the fixed assets to increase their useful life. Next comes receipts. A similar distinction of capital and revenue nature is made in case of receipts of the business. A receipt of money is treated as a capital receipt when the contribution is made by the owners towards the capital of the business. For example, equity share capital or a contribution towards the capital is made by an outsider to the business, like debentures, long-term loans, or when a fixed asset is sold. Capital receipts do not usually have any effect on the profits earned or losses incurred during an accounting year as they are not shown in the income statement or profit and loss account. Capital receipts have an impact on the balance sheet. Next, a receipt is considered as a revenue receipt when it is received from sale of goods or services, fee received for rendering technical services, or any interest or dividend earned on investments made by business, or any receipt from business activities done in the normal course during an accounting period. Revenue receipts are shown in the income statement. They are set off against the expenses in order to ascertain the profit or loss for the accounting period. Revenue recognition. Now that we have learnt about revenue receipts and expenditure, the next question that arises is, when should the revenue and expenses be recognized in the books of accounts? Should we record the revenue when the transaction is made or when the cash is received or paid? The answer lies in the fundamental accounting concept of accrual basis and the revenue realization principle. The accrual basis of accounting states that revenue should be recorded when they are earned or accrued and not when they are received in cash. Similarly, expenses should be recorded when they are incurred and not when they are paid in cash. For example, assume RT Limited made a sale of goods on 12th June 2019 to a customer on credit. The cash was received on 25th of August 2019. Hence, under accrual accounting, the revenue from sale will be recorded on 12th of June 2019 and not on 25th of August 2019. Later, when the cash is received, no revenue is recorded because it has already been recorded on the day of sale. In simple terms, accrual basis requires income and expense to be recorded in the accounting period to which they relate and not on a cash basis. Taking another example, if any advance salary is paid to the employee, it will be debited as an expense in the profit and loss account in the accounting period to which it belongs and not in the period in which it is paid. However, advance salary paid will be shown as a current asset in the balance sheet of the accounting year in which it is paid. Realization principle, on the other hand, is the point of recognizing the revenue. It states that the revenue should be recognized only to the extent to which it is certainly realizable. Therefore, just receiving an order of goods or services from the customer won't make it eligible to be recognized as revenue. The reasonable certainty of realizing the revenue will come only when the goods or services ordered are actually supplied to the customer and an invoice is created for the same. This concept ensures that income unearned or unrealized will not be considered as revenue. Further, realization principle also enables the recognition of cost incurred in making available such goods or services as expense. Thus, the realization principle facilitates a process of income measurement by recognizing revenues and also the expenses incurred with respect to such revenues. This also implies if costs are incurred in producing the goods, such costs are not considered as expenses unless sales are made. Measurement of income. Income is nothing but the excess of amount the business entity has earned from its operations over what they have invested into it over its lifetime. However, as per the going concern concept, the business is expected to run its operations for an indefinite period of time. Therefore, it is impractical to wait till the winding up of business to measure the net income earned by it over its lifetime. There comes the concept of accounting period. Accountants choose some convenient segment of time, such as a calendar year or quarter of a year, to collect, summarize, and report all information on material changes in the owner's equity, that is, retained earnings during that period. This period is usually 1 year, which could be a calendar year, that is, 1st of January to 31st of December, or it could be a fiscal year, like in India, it is 1st April to 31st of March. The business organizations have the freedom to choose their own accounting year. However, generally, as a convention, most business firms tend to have a uniform accounting period for easier comparison of results. The accountants measure the income of an accounting period by recognizing the revenue and expense of that particular accounting period based on accounting principles of realization and accrual. Therefore, accounting period facilitates a practical system of valuation and measurement. Accounting periods are bounded by balance sheets at the beginning and at the end of the period. Operations during the period are summarized by income statements. Matching concept. The determination of profit earned or loss incurred by a business during a particular accounting period requires deduction of the expenses from the revenue relating to that period. The matching concept emphasizes exactly on this aspect. It is an accounting principle that states that expenses incurred in an accounting period should be matched with the revenues of that period. It implies that both the revenues and the expenses incurred to earn these revenues must be recognized in the same accounting period. Matching concept ensures that the profit or loss of an accounting period is not over or understated. As previously discussed, revenue is recognized when a sale is made or service is rendered, not when cash is received. Similarly, an expense is recognized when an asset or service has been used to generate revenue and not when the cash is paid. It is worth noting that only when a cost is recognized or accrues during an accounting period, it becomes an expense. Therefore, cost is not a synonym for expense. Only those costs that have expired during an accounting period are treated as expenses. For example, each year's depreciation is an expired cost of an asset which is treated as an expense during the accounting period in which the asset is used. Similarly, in a trading account, sales revenue is matched with its cost of goods sold to ascertain the gross profit. This implies we should only consider the cost of goods that have been sold during the year and not the cost of all the goods purchased or produced during that period. For this purpose, the cost of unsold goods should be deducted from the cost of the goods produced or purchased. The balance amount is called as closing inventory or closing stock and is shown in the trading account. Other examples of expenses include salaries, rent, insurance, interest on loan, etc. These are recognized in the accounting period to which they belong, irrespective of the actual payment. Revenue and expense. Let us now learn what constitutes revenue and expense during an accounting period. Moreover, we shall also try to answer certain questions. Does a business only earn revenue from sales? Are there any other sources of income for a business entity? How are expenses classified in a trading and profit and loss account? Later, we will study how these revenues and expenses are shown in an income statement in order to determine the profit or loss. Revenue. Revenue is simply described as the income generated by a business from the sale of goods or provision of services during an accounting period. Revenue is also commonly referred to as the sales revenue or gross revenue. However, there are certain activities which are incidental to the main operations of the business. The revenue that accrues from such non-operating activities is known as non-operating revenue. Examples include dividend income from shares held in other companies, interest on investments, rental income, gain on sale of fixed assets, etc. Expense. Expenses refer to the cost incurred by a business firm to generate revenue during an accounting period. It is a revenue expenditure incurred for running the business operations and its benefit is only limited to the current period. Expenses are generally of a recurring nature such as salaries, rent, interest, etc. Moreover, capital expenditure such as purchase of a fixed asset is not treated as an expense as the benefit of a fixed asset continues for more than one accounting period. As already discussed, a cost becomes an expense when it is recognized. The recognition of expense occurs at a point where the corresponding revenue is realized. Now let's take a few examples to explain it better. Number 1. Rent of the office building due for the current period is an expense of the current period, even if the actual payment of rent is made during the next accounting period. Such payments that become due during the current period but are actually paid in the subsequent accounting period are called outstanding expense. Number 2. Prepaid rent related to the next accounting period paid during the current period is not an expense of the current accounting period. It will be recognized as an expense in the next accounting period when it becomes due. Number 3. Inventory is treated as an expense in the accounting period during which it is sold. Thus, the remaining unsold inventory or closing stock is not treated as an expense because it did not generate revenue during the current accounting period. It will, however, be treated as an expense in the year in which such inventory is sold. In other words, an expense is that part of the cost that has expired and been used up by activities directed at generating revenue. Therefore, all expenses are cost, but all costs are not expenses. Expenses can be in the form of payments due in respect of routine business activities, for example, wages, salaries, rent, etc., or an expired portion of an asset. For example, depreciation or amortization, or a decrease in owner's equity, that is, loss on sale of an asset, bad debts, etc. There are two important classifications of expenses. Number 1, direct and indirect expenses. Number 2, operating and non-operating expenses. Direct and indirect expenses. Direct, as the name suggests, are those expenses which are directly related and allocated to the core business operations. Mainly, these are the expenses involved in purchases of inventory and manufacturing or production of goods or services. Direct expenses are a part of the cost of goods sold by a business entity. They are debited in the trading account. Examples of direct expenses include carriage inwards, wages of factory workers, fuel charges, electricity and water charges of the factory, freight inwards, etc. Direct expenses may differ for different types of companies such as manufacturing, trading, services, financial, etc. On the other hand, indirect expenses are not directly related and allocated to the core business operations of a firm, such as production. Indirect expenses are incurred to run the business operations smoothly. They are not directly involved in the revenue generating activities. All those expenses recognized during an accounting period which cannot be classified as direct expense will be treated as indirect expense. Indirect expenses are debited in the profit and loss account. Examples of indirect expenses include rent of a building, salaries to employees, marketing expenses, legal charges, fire insurance premium, interest on loan, depreciation, printing charges, loss on sale of a fixed asset, bad debts, etc. Operating and non-operating expenses. Operating expenses are the expenses incurred for running the business operations but are not directly related to the core activities of production or trading. Operating expenses are usually connected with generating sales. The common examples of operating expenses include administrative expenses, office expenses, selling and distribution expenses, marketing expenses, depreciation, bad debts, etc. Non-operating expenses are various expenses which are incurred on non-core activities. These expenses are not related to production or sales but are incidental to the business operations. Few examples of non-operating expenses include interest expense, loss on sale of a fixed asset, legal fee, etc. Few important concepts. We shall now discuss some important elements of the income statement in detail. Number 1. Cost of goods sold. Having studied the types of revenue and expense that form the part of the trading and profit and loss account, now we will study about the expenses that constitute the cost of goods sold. Cost of goods sold is the direct cost incurred in the production of goods or services that are sold during an accounting period. It includes raw material cost, direct labor cost, and direct factory overheads assigned to the goods which are sold during a particular accounting period. The excess of sales revenue over cost of goods sold results in gross profit. Cost of goods sold includes the expenses related to the goods or inventory which have been converted into sales during an accounting period. It can be depicted in an equation as cost of goods sold equals to opening stock plus purchases plus direct expenses minus closing stock. Number 2. Inventory valuation. As discussed, assets are recorded in the balance sheet at the cost price at which they are purchased. Similarly, inventory is also valued at cost. The challenge here is that the cost of inventory purchased does not remain constant over an operating cycle. Inventory used in the production of finished goods is purchased multiple times in an operating cycle to ensure a smooth production process. Similarly, in a trading business, inventory is purchased in multiple batches to ensure smooth sales. However, the cost of purchasing inventory might fluctuate during an accounting period, resulting in different cost prices. It is because of this fluctuation in the purchase price of inventory that various methods of inventory valuation have evolved. Two of the most commonly used methods are: number 1, FIFO, which is first in, first out. This method is based on the assumption that materials or inventory purchased first are issued first for production process or sales. Hence, they are priced at the cost of oldest materials or inventory listed in the store's ledger until all units of the oldest batch are used up. Alternatively, sale of goods is made in the order in which they are purchased. Hence, inventory purchased first will be sold first. Number 2, LIFO, which means last in, first out. In contrast to FIFO, LIFO is based on the assumption that materials or inventory purchased last in order are issued first for production process or sales. Hence, the inventory issued for the production process is priced at the cost of materials which were purchased last in the order until that batch exhausts. The same process continues when next batch of inventory is used for production. This also implies that goods which are purchased last are sold first, and hence they are valued at the cost of inventory which was purchased last in the order. Number 3, closing stock. Closing stock is the amount of inventory lying unsold at the end of an accounting period. It can be in the form of raw material, work in progress, or finished goods. The closing stock at the end of an accounting period is carried forward to the next accounting period. The calculation of closing stock is done as closing stock equals to opening stock plus purchases minus cost of goods sold. Every business entity calculates its unsold goods at the end of the period and puts a value against it. Various methods are used for calculating the value of closing stock. Two of them, namely LIFO and FIFO, have already been discussed in the previous point. Closing stock is a real account and therefore it appears on the asset side of the balance sheet. Number 4, depreciation. As already discussed, fixed assets are the ones having a useful life of more than 1 year. They provide benefits to the business in the long run and thus are bound to suffer some wear and tear with the passage of time. Depreciation is the gradual decline in the value of a fixed asset over its useful life due to use, wear and tear, or obsolescence. Thus, every year the proportionate decrease in the value of the fixed asset is charged as depreciation in the profit and loss account. It is the expired cost of a fixed asset which is recorded as an expense during an accounting period. Fixed assets generate revenues for the business for multiple accounting periods. However, with each passing year, the earning capacity of the fixed asset declines because of physical wear and tear. This is why every year the depreciation on fixed asset is written off against the revenues generated during that period. It is a non-cash expense. Now the question arises that how the depreciation of each year should be calculated. There are various methods to calculate depreciation. The two most commonly used methods are number 1, straight line method, and number 2, written down value method. Any of the two methods of depreciation can be used by the business entity. However, it is important to follow the same method of depreciation every year. Now we shall discuss the basic terminology of depreciation. Number 1, original cost of the asset. This is the cost at which the fixed asset has been purchased and made available for use in the business. Number 2, salvage value. It is the expected recovery or scrap value of the asset at the end of its useful life. Number 3, useful life. The time period in years for which the asset is expected to be used for the operations of business. Number 4, depreciable cost. It is the net cost after deducting the salvage value from the original cost of the asset. This is the cost of asset to be depreciated during its useful life. Some portion of depreciable cost will expire and will be treated as an expense each year until the useful life of the asset. That expired cost is known as depreciation. Number 5, book value. The original cost of the asset less its depreciation to date, that is accumulated depreciation, is known as the book value of the asset. This is also referred to as the written down value. Number 5, bad debts. Bad debts are the accounts receivable which could not be collected by the business firm after making all reasonable efforts. We know that sales of goods and services are made on both cash and credit basis by a business entity. Also, as per the revenue recognition concept, revenue is recognized when the sale is made and not when the cash is received. Now consider a credit sale to customers of rupees 1000. The entry will be made in the books of account as debtors account debit rupees 1000 to sales account rupees 1000. Thus, the sales revenue increases by rupees 1000 and debtors also increase by rupees 1000. Debtors are shown as a current asset in the balance sheet as the payment for credit sales is expected to be received within few weeks or months. Now assume that the debtors defaulted on their payments and went bad. The business entity will have to make another journal entry in the books, and that will be bad debts account debit rupees 1000 to debtors account rupees 1000. The debtors will be reduced by rupees 1000 and an expense in the profit and loss account is created in the name of bad debts. Bad debts lead to reduction in the amount of profits as it is recorded as an expense in the profit and loss account. Similarly, a loss in collection of a bad or doubtful debt is also recorded as an expense in the profit and loss account as well as deduced from the account's receivables balance in the balance sheet. Next comes provision for doubtful and bad debts. The accounting principle of prudence states that expected losses must be provided for and expected profits must not be accounted until realized. We know that a business entity makes both credit and cash sales during an accounting period. However, all credit sales may not be realized in the same year in which the sales are made. Some realizations may happen in the succeeding year. The entity therefore has to make provision at the end of the accounting year for likely bad debts which may happen during the course of the next year. Number 8. Income tax or provision for tax. Income tax is a charge on income earned by the business which has to be statutorily submitted to the government's income tax department every year. Thus, it is recorded as an expense in the profit and loss account every year. The amount of tax liability is computed as per the law. We have Income Tax Act 1961 in India, which governs the computation and collection of income tax. However, the tax liability is determined on the basis of books of profits calculated as per law and not on the basis of net profit reported by business. A business firm estimates its tax liability usually in advance and a provision is created for the same. Provision for tax is recorded as an expense in the profit and loss account as it is created for current year's tax obligation. Also, provision for tax is shown as a current liability in the balance sheet. So, when the actual tax is paid, it is set off against the provision of tax.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.